Welcome back, folks. In today's video, I want to talk about the pound. And before I start, I want to make it very clear that this video is only for you to look at price action, okay? This is not a trade signal, and I want to make sure that you understand what I am teaching you here is all about price action. Today, in this video, I want to walk you through a breakdown of the bullish breaker setup, okay? As well as talk a little about risk management and how you can measure your risk, okay, and come up with a risk to reward ratio, okay? So on the pound, we've had a nice retracement, okay, and I believe we've come into a key support level with this gap, and I feel that the pound is ready for a pullback, okay? Not a complete reversal, but a pullback. Certainly we can still come back down into these open gaps, okay? This could be liquidity, and we still come down into these gaps and even possibly lower into these gaps that are still open, okay? Notice this was a fantastic buying opportunity. Again, 3 down candles on a daily chart, displacement come back up down into the order blocks, right, for pricing higher. Exactly the same pattern that I've shown you in a previous video on a 1-minute chart, okay? These patterns repeat on multiple time frames, okay? But anyway, back to our current lesson. Notice that on the pound, we've come into a key support PDRA, okay, so discount pricing. We've also had a nice 3-bar reversal, okay, so this down candle has taken liquidity on the left and come into a fair value gap, okay, and that's what is expected. If we talk about where have we come from, where are we going, we've come from taking all this liquidity above, and now we're seeking liquidity and or inefficiency in the opposing end, and I believe we have come to that level and rebalanced a level of inefficiency and shown immediate rejection with this 3-bar pattern, okay? And we can see on Friday, we also continued higher, had a retracement into this down candle as a rebalancing. And so the next few days may be strong bullish days, okay? So into next week. But obviously, there is an element of risk even on this chart because this just could be liquidity. Okay, we've got nice equal lows, okay, below which reside obviously a lot of stops and further inefficiencies, okay? So there's obviously an element of risk that needs to be managed. But for your learning experience, I want to talk about the bullish breaker setup and how you could profile this particular trade for repricing higher and where your stops could be and where targets could be. That's what I want to talk about in this video. So we've now assessed that perhaps the direction in the interim is to the upside. So if I'm looking at this, I can form a bullish bias, not a complete reversal, but perhaps just a pullback based on what I've just discussed. If I now drop down to a 4-hourly chart, I want to talk about the bullish breaker. A bullish breaker, I've spoken about this previously, okay, and I'm going to just take this off, okay? We don't need that anymore. So bullish breaker occurs when you have a low, which we have down here, swing low, okay, a high, okay, swing high, a lower swing low, okay. I discussed this exact pattern in gold in a previous video recently, and then you have a higher swing at the top, so we've broken structure, okay? Body candles on this chart have closed above this swing high. Why is that swing high important? I've mentioned before, this is the swing high, okay, that's created this swing low, okay? And now we have closure above that swing with body closures, right? Not just wicks above. So to me, that is a break in market structure, a bullish signature. This last up candle, okay, is the bullish breaker. The last up candle in that swing high is the bullish breaker. We've already come into there and we are getting a reaction from there, okay? So I want to see if we can get a pullback early next week into this gap, okay, for a potential repricing higher, okay? Now that could be from this level, right? Which is a bullish order block, and that's where we have had this displacement. So price should retrace back down to the bullish order block. Notice that that down candle has taken all this liquidity on the left, okay, and we've now formed the bullish breaker. Coming down into there is still within this up candle, which is that bullish breaker, but I think we may only come down to that level, okay, which is kind of the midpoint of that bullish breaker. So that's a personal choice now. One could, based on their own trading plan, okay, take a expectation that we would reprice higher from there or reprice higher from there, okay? Both are valid, but it just depends on how the market behaves. You could get a move down, for example, that wicks into that area, but the bodies may just come up to that area. That's also possible. It all depends on how aggressive your personality is in terms of taking advantage of any particular opportunity. Some people are conservative. They want the best of the best entry, okay, which would be back down to that down candle, which is the order block. And so anywhere from the high to the open of that down candle would be the sensitive area. If the market were to reach down there, that would be a valid entry using the bullish order block there. Some people are more aggressive and they will enter above, okay? Now, for me, if I were to take this opportunity, I don't trade this market, okay? This is more of a example to teach you the bullish breaker, okay? Any entry on that would need to be either below this low. Okay, again, it needs to be within your own risk tolerance levels. Okay, everybody has their own way of managing their own risk, their own tolerance. Okay, their own trading style. Below there would be a acceptable stop loss level. Okay, or you could also, one way that I like to do it is I will usually take this wick. Okay, and have a stop under the midpoint of that. So if the market were to trade below the midpoint of that wick, okay, then I would consider myself to be wrong on that expectation that the market's going to be going repricing higher from that level. And in fact, it's actually now seeking liquidity lower. Okay, so if we need to measure our risk in terms of how do we get a ratio between a risk and reward. Okay, let's first talk about where this trade may be headed. I think above these highs into this rejection block would be a viable projection. Okay, so based on that, on this 4-hourly chart, on TradingView there are some tools. So if I click on the long position, I'm going to say I'm going to enter there, and for this example I'm going to use a stop just under the low. Okay, right there, and target would be just under the midpoint of that rejection block. Okay, now that's one way to think about this opportunity for the long. Again, I'm not saying this is a trade signal. Okay, we're learning about how to measure risk to reward ratios, and we're learning about how to use the bullish breaker as a bullish signature. Okay, so that will be one risk profile. I don't like risk profiles of less than 3 to 1. Okay, so this is basically saying that this is a 2 to 1 risk to reward ratio. So for every $1 risked on this particular trade, we would yield $2 in profit. Okay, 2 to 1. Now we can further refine this by looking at this on a 1 hour time frame. Okay, so I'm going to drop down to a 1 hour time frame to see can we improve the overall position from a risk management perspective. Okay, so we have a fair value gap. Okay, here let's actually mark out on the 4-hourly where our entry would be on a 4-hourly. Okay, so I'm just going to mark that level. I'm going to go down to an hourly chart now. Okay, so looking at a 1 hour chart, we do have a low here inside of this fair value gap. This is our entry on the 4-hourly chart. That's the order block on the 4-hourly chart that we want the market to come back down to. And I think this here could be the liquidity that is needed to bring the market, fueling the market to come lower. Okay, so let's using our tool here, say we go long from the same level, but now our actual exit or stop loss can be a little bit higher because now we can target the low of this candle, okay, which is the first candle out of the 3 within this fair value gap. So that fair value gap from where we're entering, okay, above the 4-hourly order block, there's a fair value gap there, and that fair value gap is made of 3 candles: candle 1, candle 2, candle 3, and the fair value gap is in between those 3 candles. Put a box at where the fair value gap is. Okay, so in terms of stop loss, we can put it simply under the first candle out of the 3 where this fair value gap resides. That should improve our risk to reward ratio. Our target is going to be the same. Okay, it's going to be still up at the, just up here, which is just prior to the midpoint above these highs into this rejection block. Okay, now you can see we're closer to 3 to 1. Okay, so for every $1 risked on this particular trade, we would yield $3. Okay, so that's kind of how I would assess this opportunity and refine down to a 1 hour chart to see if I can get a better entry and a better stop loss level. Okay, target would remain the same. I want you to monitor this. So this is the risk profile now. I want you to monitor this. 2 things I want you to look at. We can take this off now. Do we come down to this ultimate bullish order block on a 4-hourly chart? Okay, or do we stop at this level? Okay, and that is, both of those are within the bullish order block. Let's also mark that out here. That's the bullish, sorry, not bullish order block, bullish breaker. Okay, I'm going to see if I've got a better, yep, there we go. Okay, so the points on the chart, these horizontal lines you can see are within the bullish breaker. Okay, I prefer this top line because that kind of aligns with the midpoint. You can see there's a midpoint of the bullish breaker, and I want to see the bodies remain above that. Okay, but we may wick down all the way down to this down candle. So it's for you to monitor this and see, do we get a reaction? Okay, and do we get a reaction and get up to our targets? It's for your monitoring, right? It's for your learning how price behaves at these key levels. Okay, I also want you to monitor the day and the session that we get this entry and a good reaction. Is it going to be, I want you to focus on, for example, this is the pound, so it should be in the London session or the New York session. London session, look at the time. It should be, best entries that from my experience are 2:30 a.m. Okay, for the London session. For the New York session are 9:30 a.m. and the best days, right, are Wednesdays and Fridays. So that's what I want you to focus on. Okay, take this opportunity to watch this market so that you can learn from how the market behaves, how we've identified these levels in terms of the entry, the stop loss, the take profit level, as well as how we've refined from a 4 hourly to a 1 hourly chart to kind of get our stop loss a bit tighter to be able to get more reward for the risk. Okay, again, repeating, this is not a trade signal. This is for your learning experience. You're going to learn by watching this, okay, in real time, if you can, seeing how the market moves. What does it do? Maybe it just will move up next week, not even give you an opportunity to get optimal pricing because it's already come in to the bullish breaker and maybe just continues higher. Okay, but in my experience, because this gap hasn't been filled, okay, this should be liquidity for this to come back down to offer a discount price for the institutions. Notice also we have again the dump for the pump. Okay, so we've got the dump. That's important. I'm only taking longs on any time frame when I have a dump. Okay, if I didn't see this dump, I wouldn't be interested in this position. Okay, so I hope this video is useful. Monitor this market over the next couple of days. Take notes of the days and times you see reactions and how the market's panning out on those days, at those times, in those sessions that I've mentioned. Okay, I will now talk with you in a future video.